We've got a lot of volatility, there's been a lot of drawdowns, and we really want to put all of this into context within our investment framework and talk about what's happened so far and where we think it's going to go from here. First chart we're going to throw up is to look at the start of the year for the Russell, the small cap stocks, the S&P, and the NASDAQ.
Yep. And it's been a tough start to the year. I mean, worst start to the year since around the Great Depression. Most major equity indices are either flirting with a bear market, which would be something like 20% down from the high, or already in bear market. Obviously, have spent most of the year in technical correction territory, down 10% or more. So, pretty significant drawdowns that global equities have experienced year to date. And obviously, at this point, once you talk about being in a bear market, there are a lot of folks that are saying, well, has the market already priced in a nasty macro outlook? Mm-hmm. Is it time to buy?
Right.
And so that is the $1 million question that we need to put through our framework.
Right. And I think it's safe to say, like, there's a lot that's happened since the start of the year with the Fed rate hikes, with the Russia-Ukraine situation. It's more than this potentially that we're seeing now. So Our framework is sort of lays out what we think is happening, and we'll take a look at the elements of the framework and just discuss where they're trending. So we'll throw up the next slide, which is our liquidity framework. And This really is a look at where global liquidity is now, has been, and where it's heading.
Mm-hmm. Yep. So the big things that matter in terms of the macro setup for asset classes, liquidity, growth, and inflation. The first is liquidity. When we talk about liquidity, we're talking about growth of the money supply, M2. And we divide all these things into different regimes. So you can have a low and rising regime that's usually pretty supportive of equity prices. You can have high and rising, that's also pretty supportive. And the worst case scenario for liquidity is low and fall. Mm-hmm. That's a very difficult liquidity environment.
And just for the purposes of the viewers, explain liquidity, what that is, and how it impacts the economy and markets.
Yeah, liquidity, it's the growth in the money supply. And we say money supply or the growth of the money supply is the fundamental above all fundamentals. Because if you need to think about where is the next buyer of financial assets going to come from, well, you need money to buy financial assets. And so if money is being created, money supply growth is high, rising, that is a tailwind for most financial asset prices.
So as you can see in the green bars here, that was during the COVID period, mm-hmm. Money supply increasing rapidly. And then we move into March, it starts to fall just a little bit, but then as you move further into the year, it decelerates quickly. So explain how we project this out.
Yeah, the way to think about it is what's built into the forecast is the Fed hikes interest rates as the market expects. They roll down their balance sheet as the market currently expects, and we don't get any significant fiscal stimulus. And so if the Fed continues on this path, they are going to slow the growth rate of the money supply pretty dramatically. And that's how we're going to get into that low and falling type regime. Even if the Fed were to stop hiking interest rates right now and stop reducing the size of their balance sheet right now, we would still be in a low and falling environment at the end of the year because the year over year base effects mm-hmm. are so incredibly negative because money supply growth was so high approximately a year ago when the CARES Act came through. And the American Rescue Plan and all that. So it seems like it's sort of baked in the cake. We're heading into a low and falling liquidity environment.
And so in the graph below, we're showing that the different regimes that the money supply flows through, normally the money supply grows by 6% a year. Mm-hmm. So we're showing that this sort of pivot point here, we're projecting it to go significantly below that.
Yeah, broad strokes, falling liquidity is not good for anything.
Right.
It's worse for growth stocks, falling liquidity, than it is value stocks, mm-hmm. but it's bad for equities.
And what reverses this course here? So we've got it sort of heading from the 10% area to the 0% area. what reverses that? Not just the Fed stopping, but what actually reverses it and makes it go the other way?
Yeah, at this point, because the base effects are so strong, the only thing that would get it to reverse would be if the Fed started cutting interest rates, adding to the balance sheet, or we got a new wave of fiscal stimulus. That would be it. We would have to go back to pandemic era type monetary and fiscal policy in order to avert the bottom left quad here.
And all of those things are inflationary, and given our current inflation state, highly unlikely, right?
Yeah, right.
Okay. So let's look at the next chart, which basically just illustrates the historical growth rate of the money supply.
Yep. And in the light blue area all the way to the right, you're seeing our forecast. So right now slowing down to something like 0% year-over-year change as we get towards the end of this calendar year into Q1 of 2023. And once again, even if the Fed were to stop everything right now, you wouldn't come down to 0, but you'd come down to about 1, which is still very low and falling. So it's sort of baked in the cake.
And can you have negative money supply growth?
I've never seen negative money supply growth. It's certainly not acceptable right now to just take money out and burn it and destroy it. It doesn't make much sense, so we don't see that.
Yeah. So let's move on to our outlook for growth and where it was sort of coming into the end of last year and where it is now and how it's changed so dramatically.
Yeah. The outlook is for sort of moderating growth. You can see the chart at the bottom how the blue line is approaching the center. We're approaching a level where growth year over year should be stabilizing somewhere around the average of 2.5. But what is important to note is when we came into the year, the forecasts were more like 4% growth at the end of the year. So they have come down quite a bit. And we still think the risks to this forecast are to the downside. Estimates across the board for economic growth this year have been ratcheted down.
Last quarter was negative 1.4. What has driven that so hard to the downside?
Yeah. Well, there were a number of transitory factors that were blamed early on, like the impact that the Omicron variant had on labor supply, and then obviously the impact that the Russia-Ukraine crisis had on net exports, these types of things, and then additionally an inventory drawdown. But more and more now, what you're seeing is estimates are coming down later in the year because it's clear inflation is starting to bite real consumption.
Yeah. So let's look at the grid here and explain our forecast and how it's evolved and where we're looking for the rest of 2022.
Yeah, when we came into the year, what you would see is the top two regimes, so low and rising, high and rising, had a much higher probability as we got into the forecast horizon, so for all of 2022 and early 2023. And as the year has evolved, you've seen the high and falling, low and falling started to get a higher and higher probability to the point where now it's very likely that as we get into Q4, we're going to see a low and falling economic growth environment, which historically is not a good thing for equities.
In terms of forecasting economic growth, there's a chart here that sort of lays out the rest of the year. What are the components that we're using to forecast economic growth?
Yeah. The things that move the needle the most are inventories. If we get an inventory build that contributes to economic growth, that was Q4 last year. We had a real hot GDP print Q4 of 2021 because everybody was struggling to get inventory, and then, they finally got it.
Right.
And then Q1, we had a big inventory draw. So understanding where we're at in the inventory cycle, that's a big part in predicting economic growth. More and more, we're seeing companies say, I have too much inventory. So I'm going to stop new orders, and I'm going to just sell what I have, and maybe at a lower price because I'm going to have to discount it. So that's a big thing. Another thing that really changes the year-over-year growth is investment. Fixed investment by businesses, that's a huge part of economic growth. A lot of those estimates are still pretty strong. That's sort of why you're seeing estimates throughout the year still coming in around 2.5%, but that can change on a dime. If the economic outlook deteriorates and companies change their plans, that could definitely bring those estimates down.
Right, because if you just looked at this chart, things still look relatively fine, right?
Right.
So maybe let's move on to what could change that so dramatically and so quickly. And I think the first component of that is inflation.
Yep. So this is year-over-year change in headline CPI. Once again, is it low or is it high? That dividing line is right around 2.7%. So if it's above 2.7% year-over-year, that's high. If it's below, it's low. And then is it rising or falling? So we had been in a high and rising regime pretty much since the inflation shock started April 2021. Very elevated, and it just kept going up. It was 8 consecutive months that the year-over-year change in inflation got higher and higher. And the April CPI print that we just got mid-May, it's the first time where we went from 8.5% year-over-year to 8.3% year-over-year. So we finally got to move into the high and falling regime, which is good news, bad news.
Mm-hmm.
Good news is high and falling is great for bonds. That's historically the best macro environment to own bonds, because when inflation is high and rising, which usually comes before high and falling, yields go up.
Right.
And so you're starting this new regime of high and falling with relatively attractive interest rates. And when inflation starts falling, yields tend to stabilize or perhaps go down, which is great for bond investors as well. The bad news is we're going to be high for a very long time. Probably won't come down to 2% headline inflation until end of next year, perhaps. And so this is what puts the Fed in a very difficult situation, which is why the liquidity outlook is so bad. Because if the Fed is trying to get inflation down, well, it's just going to take a long time. And so they're just going to keep hiking. And they might not even understand the negative economic impact of what they're doing until it's too late. Yeah, if you go nice and slow and you do 0.25 percentage point every quarterly meeting, what you can do is wait and see the negative economic impact of your monetary policy. But if you go quickly and you're going 0.5% at consecutive meetings, and you're doing an entire rate hike cycle and you're compressing it into 12 months, it's kind of like trying to park a mega yacht. You know, you're going 40 miles an hour and you have to get it right at the dock, and you're only a couple miles away from the dock.
Right.
Odds are you're going to hit the brakes way too hard and you're going to stop short and everybody needs to get out on a lifeboat. Or you're not going to hit the brakes hard enough and you're going to go crashing into the dock.
Yeah.
And that's kind of what the Fed's trying to do.
So what things in particular break because of this? So like mortgage rates. Like, talk about the impact of such rapid hikes on real things.
Yeah, for sure. Mortgage rates, for example, we've had like a 2 standard deviation move in 30-year fixed mortgage rates. I mean, and if you were to pull up a chart of home prices versus mortgage rates, all you have to do is invert the mortgage rate line. But as mortgage rates go up, home prices go down. I mean, and then that generally flows through to things like housing construction, wealth, all those types of things. So just how quickly the Fed is having to hike because they're so offsides on this whole inflation scenario, it can slow down economic growth quite fast.
Cap this section on where inflation, we're projecting it to head, because we have it coming down fairly rapidly here and leveling out above trend for a while. So where could we be wrong here, and how do we sort of project the inflation coming down?
Yeah, the slope of that dashed light blue line could be wrong. I mean, it could be way flatter. It could come down quicker. But where we're probably not going to be wrong is the fact that it's going to be high and falling. It's almost a certainty. Over the next 4 quarters, there's almost a 0% chance that basically the March 2023 inflation print is below 2.5%.
Right.
That's almost impossible. You would need to see a deep recession like right now to get there, which we're not. We're not seeing that in the data. You could be wrong and say that inflation isn't going to come down as quickly, but it's very unlikely that it keeps going up from here.
Yeah, the math it makes it almost impossible. Let's wrap this up with sort of a summary of, we don't want this to sound like it's terrible, terrible news. It's, the data is what the data is, and it's changing the way it's changing, and we're just focusing on that. However, it doesn't mean there aren't opportunities to invest your money, our clients' money, into good opportunities. There's still a lot of opportunity out there. Fixed income for one.
Yeah. One of the best macro setups we've ever seen for fixed income, pretty much across the board, whether you want to buy short-term bonds, intermediate-term bonds, long-term bonds. So diversification has not worked year to date.
Right.
Because equities were selling off and we were in a high and rising inflation environment. Now you get a nice yield, great macro setup. So that's actually something we're excited about. Excited about bonds for the first time in
long time.
I don't know.
Yeah.
And then if you look at across the equity spectrum, well, this macro setup, it's not great for growth equities. It's actually not that bad for value equities. High quality dividend paying equities. It's not that negative. And now they look very cheap. Small value equities, for example, are significantly below their long-term trend. Because they've gotten beaten down this year like every other equity style, but the macro setup isn't bad for them, and they look cheap. Large value equities, high quality dividend paying stocks, they've outperformed in this down market. They're still below their long-term trend, and this macro setup is not nearly as negative for them as other areas of the equity market. So there are opportunities. I mean, anytime the market broadly is down around 20%, something's going to look cheap. Right?
Yep.
And we're seeing that. I mean, we have every asset class that we run through our framework, every major asset class. There are things that we are getting excited about, you know?
And stepping outside the U.S., there's going to be opportunities that present themselves in foreign markets.
They are trading at 20, 30% below trend. When prices get that attractive, you say, all right, well, clearly negative stuff is already priced in. And I honestly, you just, how the framework works out, you should care less about the macro setup when something's that cheap.
Right.
Because, you know,
I mean,
there's just a tremendous
as long
amount
as your
of upside.
time horizon dictates you can, yes.
Right, exactly.
Yeah. But, I mean, I think that's good perspective to share. There's always an opportunity to invest money at in different diversified asset pools, and at some point these growth equities that have been selling off will look attractive again.
Yeah.
And